Thank you, everyone, for tuning in and for everyone that's shared their questions in advance. For those of you that don't know, my name is Shafin Diamond. I'm the CEO of Victory Square Technologies. Alex, can you go to the next slide 3, please? So today, we wanted to cover a couple of different items. I thought we would, as a refresher, do a quick snapshot on VST, do a brief 2022 recap, share some of our outlook for 2023, and get to a Q&A. Throughout the webinar, there are some questions that might be more relevant to some of the slides, and so I can answer them throughout. So let's go to the next slide, Alex. Perfect. So quick refresher on Victory Square. We're a venture builder focused on investing in disruptive innovation. We provide investors a liquid way to invest in early stage technology companies without buying a venture fund that requires accredited investor status or multi-year commitment. So Victory Square is a great way to diversify into early stage venture. Quick highlights of the business. We've got a diverse portfolio of about 25 companies. The sectors that we focus on are digital health, AI, artificial intelligence, machine learning, blockchain, virtual reality, augmented reality, and mixed reality, gaming, and climate tech. We have a NAV of approximately $80 million, which currently, I think our market cap as of today is probably around 13. So there's definitely a big gap between the value of our assets and what our current market cap is. We've got cash and liquid securities of approximately, I think, 6.8 million. And we've got strong inside ownership for VST. Alex, can you jump to the next slide? So I wanted to, there's a lot of questions and comments that have been coming in over the past couple of months. And I wanted to, in addition to kind of doing a quick refresher on VST, I wanted to highlight our business model, because there are a number of things in our business model that I think may explain why we do certain things, and answer some of the questions that we've had around things like working capital, debt, using Victory Square shares for investments and acquisitions and such. So our business model is to buy, build, and invest in early stage tech companies. This process, given that we come in early in almost at a pre-revenue stage, it takes time to build these companies. So we may spend up to 48 months with those companies until they're ready, or until we feel they're ready to kind of spin off or stand on their own. Now, there are a couple of very unique elements and advantages to our business model. One is access. So for those of you that have never visited Victory Square or know much about our background, but we had a physical incubator in Vancouver, British Columbia. There was about 12,000 square feet of space. And we had relationships with about 80 other accelerators around the world. So a lot of our, companies, startups, teams, came from a variety of different places. So we had this unparalleled access, to get access to some of the, the brightest companies in the sectors that we were focused on. Some examples of those, you look at Hydrate, the founder, Shane, originally from Ireland and, through Hydrate's headquarters in Vegas, or Shabir and Kaman, who are the founders of XRI, come from Sri Lanka and Bulgaria. Matt Bailey from Game On, Australia by way of New York, and Ganesh of CQT from India and now in Canada. So, we were able to find some of the, some of these brightest minds in the sectors that we were in because of this access that we had. The second is we get actively involved. So our management team and advisor network are involved in these businesses from incubation, all throughout monetization. So we spend time either on the board or assisting with financial, operational, and marketing and strategic support, with these companies. So, again, we're not sitting on the sidelines. We're seeing what's happening with these businesses as they evolve and grow, and we're able to actually act and play a role. And we take material stakes in a lot of those companies as well. And the third is, we drive value by monetizing investments and then reinvesting the gains into new innovations. So, this last part of this cycle of an individual company is important here, because we had built Victory Square to be, a self-sustaining business, a business that as companies graduate or get spun off, there are ways by which we're able to, to bring capital back in to start rebuilding the funnel and compounding this growth, over time. So there have been a number of questions kind of that have come in around, I mentioned working capital, debt concerns, dividends, and even VST issuing shares for acquisition. So I want to answer them with this slide kind of up. So I mentioned the last part of this where we drive value by monetizing our investments and reinvesting those new gains. At this point in time, as a company, we have a couple of options. One is to take money off the table. So if we see that our investments have been spun off and the value of those shares or stakes has significantly, increased, at those points in time, we can take money off the table. And we've done this in the past. In 2020, we did this with Fans Unite. Anyone familiar with our portfolio company, Fans Unite, went on a run at the end of 2020 and the beginning of 2021. And we were able to get some liquidity when the share price was trading high and take that capital and invest it in new initiatives that were coming into the mix, like Hydrate as an example. Hydrate was a company that we acquired in early 2021, but we were able to use some of the from the sale of Fans shares at those levels to reinvest in building up, Hydrate, which we've now seen kind of the results on. And we also had another company, Argo Blockchain, which we were able to get liquidity when that was trading up. So that's one way that we're able to, again, get liquidity to rebuild the funnel and invest in the business. The second is an equity raise. So, as companies start to be spun off, there's more validation on our ability to find these companies, grow these companies, and spin them off. And so at different times, there may be an interest level for us to do an equity raise if we believe that the share price and terms are reasonable. So in November of 2020, we did a financing where I think we raised about 5.8 million Canadian dollars at 52 cents a share. And just to note, I participated in that financing as well. I think for close to $500,000 at 52 cents. So again, at that time, we felt that the share price was trading well. There was an opportunity to bring in some strategic investors. And we had momentum, so we were able to do that to bring capital back into the company. And the third is accessing debt secured by our investments. So if we believe, so in today's market, we believe the value of our holdings are more valuable than what their current share price says. So we have no intention of selling, significant assets in our portfolio. Two, we don't want to do an equity raise because we feel that would be too dilutive. We believe that the share price is undervalued, so we would not do that. The third option is one where we would. So if there's, we look at debt if it's secured by our assets or our investments. So in this case, there's no, dilution to Victory Square. But we believe that, again, that our assets are more valuable and our share price is more valuable. So we would access debt in this case, which we did towards the end of last year, 2022. It also makes sense if we feel that we can use that capital to create a greater return than, let's say, our cost of that debt. So again, the negative comments around debt, we at Victory Square don't agree with those comments, because for us, strategic debt, whereby which we're using both the security and paying the interest with currency being, assets that we own that are trading at or valued at a significantly higher multiple than our cost base. We think that makes sense for us, as opposed to the alternative, which is to either stay idle and not grow, or to do something dilutive in an equity raise, or sell assets, which we think, again, are going to be, more valuable in the future. The other question that we get asked really is around working capital. So for Victory Square, we have, a monthly burn of around, I would say about 100K Canadian a month. And we have, approximately 6.8 million in cash and liquid securities. So we have no working capital concerns in the business. And I think as we see opportunities currently where there are a lot of distressed, assets and products out there, we have the ability to, pursue M&A within our specific portfolio companies within those sectors. So for VST, we have no working capital concerns, and we're also in a position where, again, if we see opportunity, we do have means and resources to be able to look at those, whether it's internally incubated within VST or it's within, by one of our portfolio companies. And specifically, I think, as you'll see later on in the deck, our focus right now is really on the digital health sector and space, and pushing through our first mover advantage. And in that sector, both of our main assets are funded, so there's no real, liquidity issues or investment issues to kind of grow those. The other question that we get asked, which I think is important and relevant to this slide too, is about the dividend strategy. So for those of you that remember, the dividend strategy for us was to benefit VST shareholders, but also to build a shareholder base for our spin-off companies when they were spun off. And in 2021, we gave 3 common share dividends. One was in Game On Get, and 2 were in VRAR, which is XRI. This didn't have a positive effect on VST's share price, and it created a lot of downward pressure for our spinoffs and their market caps, which ultimately, has a negative impact on VST's NAV. Now, we believe that this had more to do with just the negative sentiment and significant decline in the microcap space and the broader markets, and so we still believe and we still like the dividend strategy. For us, this is a strategy that's not going away. We just felt that when it was executed in 2021, timing wise, it ended up being negative for the portfolio companies, for VST, and for our shareholders, I think, because of a lot of, external concerns. So we like the dividend strategy. However, our game plan now is to wait until the end of each year to kind of reassess the overall market climate. And we believe that it's important to give our portfolio companies enough time to mature, establish their own shareholder base, and then it would make sense to either issue a share dividend or even sell some of our position and dividend out the proceeds as cash. So around dividends, we like it. We just want to make sure that when we do it, the companies are more mature, they built up a shareholder base, and it's when the investing climates kind of come back, so that it doesn't have a negative impact on the portfolio companies, VST, and or our shareholders. I want to just kind of touch upon one other point that I just talked about earlier, which again is with respect to using VST shares. So we use VST shares when they're trading at a premium as a tool to invest. We've done this in the past with Fans Unite, Hydrate, Game On, XRI, CQT, and yes, there's dilution when we do this, but we believe that this is a strategic advantage. One, we're using this when we believe that our share price is trading at a premium. Two, when we make these investments and these acquisitions that are material, these shares are going into the hands of people that we believe are going to be strategic and valuable stakeholders for VST within the family. So when we make an investment or acquisition, some things to look at from a risk mitigation perspective are that, that tech, that company's customers, and or that team can cross-promote or work with our other portfolio companies to strengthen our ecosystem and give our companies a higher chance of probability, of success. And so for those founders of our portfolio companies to also have a vested interest in VST, we believe that that's strategic and important. And we're using that when, our share price is trading at a premium. We're not making those deals when our share price is trading at the levels that it's at currently. Alex, can you switch to the next slide, please? So, as part of a recap of 2022, there was a good piece of advice we were given, which was when you're running a public company, you're actually running 2 companies: the operational company, which is the day-to-day business, and the capital market company, which is the day-to-day share price. Now, with respect to the capital market side, 2020 year was a very bad year. Our share price declined by 63%, from the beginning of the year to the end. Now, not here to make excuses, but when we look at this, we believe that there's a high correlation to the microcap space in general. The microcap space is driven by sentiment and momentum, and both have been and are currently negative and pretty much non-existent right now. And this is evidenced by the lack of volume in the space overall. To take that a step further, when you look at the decline, our decline of 63% basically mirrored the CSE index. So the CSE is the exchange that we're trading on. The CSE composite index was down 63% over that same period of time. The S&P TSX Venture Composite, which is the TSXV, which is the other microcap exchange in Canada, declined by 40%. So the index as a whole was down 40%. And then even if you look at the NASDAQ Tech 100, there was a decline of 33%. And these are, large, big blue chip type tech companies. So when we look at the capital market side, we believe that there is, a high correlation to what was happening in the market overall. Now, we have no control over these variables. And so we can't predict when the market will turn. What we can focus on is our operational company and the variables we can control, which is, the business, the operational day-to-day business. Alex, can you jump to the next slide, please? So in 2022, we had, two companies spin out. Ternium Technology Group, which was a minor investment for us. So it's not a core holding, and we're not actively involved in that business. And then Hydrate Technologies, which Victory Square owns approximately 74%. It's an active business. It's a core focus of ours. And this is these two additions were following in the suits of our other public portfolio companies, Fans Unite, Covalent CQT, Game On Entertainment, which is the ticker GET, and XRI, which is the ticker VRAR. In 2023, there are two more portfolio companies that have started the process of listing. One is Stardust Solar, which is our renewables, climate tech, solar kind of business, and Draft Label, which is in the digital health space. Alex, can you pop to the next slide? So, where are we at today? Over the period of, from 2017, we've evaluated over 1,000 companies and startup ideas. 25 have kind of met the cut for what we're focused on. We've invested approximately $13 million, and our portfolio NAV sits at around 80 million. So we've seen growth of approximately 4 million in 2017 to today, where we're sitting at around 80 million. And our goal is to continue to grow our NAV going forward. One thing to note, when you look at the growth in 17, 18, 19, you see kind of a consistent pattern of growth, and then there's kind of this anomaly year in between where everything jumps, and then you see that number kind of decline as we go into 2022 to 80. And I think that is a correlation to what was happening in the markets over that shorter period of time. But if you look at the long-term projection, our NAV has been growing year after year, and we the plan is for it to continue to grow. Now, we've heard a lot of negative comments about our NAV and how it's calculated, and I understand this. I understand people questioning this, because if this is the number that we're using, that number is only valuable if the process of calculating it is valid. There was a webinar we did, I think it was at the beginning of last year, where we disclosed our NAV, and we walked shareholders through that. I'll ask Alex to kind of share that after, but we'll be doing another one of those closer to our year-end financials, our 2022 year-end financials, which are due at the end of April. We'll do another webinar where we'll walk through, again, the breakdown of NAV, where we'll go through each of the portfolio companies. And we'll also actually have a webinar specifically on the financials as they're released, to kind of break down what's VST and what's consolidated. But I think for the purpose now, really is qualifying how do we calculate, this NAV number so that investors, believe the number because they believe that the processes of coming up with that number is valid. Alex, can you jump to the next slide, please? Our portfolio is broken into 3 categories: public holdings, private holdings, and incubating. So for public holdings, the way that the NAV is calculated for these investments is basically mark to market. We basically look at the most recent trade multiplied by the number of shares we hold in those companies. And that's how that number is calculated. So when you look at that number, it sits at around $21 million right now. From a private perspective, our auditors have a third-party pricing agency, and there's currently one being reviewed right now as part of our 2022 audit. They value the majority of our private holdings, and we also use most recent financings, term sheets, and in some cases, management review to value some of those private holdings. Now, here, all public companies are required to hire an auditor. We have to pay that auditor, but that auditor is meant to audit the company according to CPAB rules. And so even though we pay an auditor, that auditor is meant to is to audit the company in the best interest of all shareholders. And that auditor, again, because of the complexity of Victory Square's file, requires a third-party pricing agency to come in and answer and value those companies. And one of the questions later on that we'll touch upon what information that all of the private companies are required to present and provide to the auditors in the third-party pricing agency, as part of their, valuation number. It's not just a random number. There's DD that goes into each of these cases. That value sits at approximately $48 million. And then we have the last category, which is incubating. So with respect to incubating, this represents the smallest value, and we believe we take a fairly conservative approach, but we're always incubating new IP within Victory Square. And we generally use a cost base on some of these wholly owned incubating startups that we have of anywhere between 1 and 2 million Canadian dollars. These are all management reviewed, and the value of those is approximately $9 million. So, collectively in total, you're looking at, between, I think, around $78-79 million dollars for our NAV. And when you look at where our share price currently trades, which I think is around $13 million dollars, there's about an 83% discount, to our NAV. And generally companies trade at a discount to NAV, but this is a significantly greater discount to NAV than most of our comparables. Now, if you look at this and even if you were to mark this NAV down by 50%, you're still left with, NAV of around $40 million, which still equals around 40 cents a share. So you could even take, a discount on that number, and it shows that, there is a lot of value under the hood. Now, again, I agree with some of the comments which around the NAV, which is the NAV is only valid if the method and the party calculating it is valid. And so, auditors, we have to use a third-party pricing agency to do that. And later on in one of the questions, I'll kind of list off like what information each of these companies has to provide the third-party pricing agency to even come up with a valuation. It's a pretty, strict due diligence process. Alex, can you jump to the next slide, please? So, one of the big things within the Victory Square model is we've got a wide portfolio of 25 companies. There's probably 9 or 10 that I would say are core holdings where we have a material holding that can significantly impact the success of the business. But there's one in particular. So in any portfolio, our goal is to diversify, have anchors in a variety of different sectors. And you want to hit those singles, doubles, and triples, but you look for an outlier. And this is kind of a common model in a lot of venture investing, venture build, venture studio, venture capital type models. And I want to highlight Hydrate because I think we're very bullish on it, and its success will have a huge impact on VST and its You know, so quick recap for people that aren't familiar with Hydrate. It's a wholly, it used to be a wholly owned portfolio company, which we acquired at the beginning of 2021. We acquired it in an all stock transaction where we used VST shares, which I think were, priced at around 63 or 64 cents. And the transaction cost without earnout at the time was around $2 million. Hydrate is quickly, become an industry leader within this digital health space, specifically within this nursing category in the US. They've built a turnkey platform that allows nurses to participate in the practice of mobile medicine in all 50 states. Hydrate went public in December 1st of 2022. The valuation at that time, I think when it was financed, was around 17.5 million Canadian dollars. So again, really big sector. We had a very strategic acquisition that was favorable for VST. We invested capital into Hydrate that we were able to get from proceeds of the sale of Fans United in 2021. And our team got actively involved in building that business up. And it culminated with, the listing of Hydrate on December 1st. And now the, continued momentum of that business. Now, with the business specifically, in order for a nurse to be able to offer services outside of a clinic or a hospital, they need to have a medical director, the technology, the proper licenses, and access to, pharmacy to provide, the prescriptions or the goods that are part of the service that they're providing. So Hydrate has built an all-in-one solution for nurses. It includes a white label platform, a medical director, a pharmacy, and all the required licenses that allow that nurse to start his or her own mobile health and wellness service kind of overnight. And trend-wise, North America is the largest region in the global digital health market. It accounts for, I think approximately 40% of a $250 billion global market. And this, COVID accelerated the acceptance and adoption of virtual and at-home care. And so you're seeing a compound annual growth rate of around 6%. And this market is expected to reach around 600 billion in 2026. And we believe Hydrate, specifically, with their first mover advantage in this nursing category, is poised to, carve their share of that market. From a numbers perspective, in 2023, Hydrate's on track for around 22 million in top line revenue. Alex, can you jump to the next slide, please? And again, this has a significant impact on Victory Square. So with their 2023 projections, they're on track for, I think the top line is 22. Total revenue from a GAAP perspective, I think will be closer to 12 to 13 million. Now, when you look at the multiples in that category, you're looking at multiples and they're comparables. Now, there are comparables that are NASDAQ, like large Fortune 500 multiples, which, we don't use because, again, those companies are in the billions of dollars of revenue. But when we look at the micro cap and small cap space, when we look at comparables to Hydrate, you're looking at an average multiple of around 17.1. And so from a market value perspective, we believe that Hydrate will end the year, with those numbers. We're very confident that they'll hit those numbers. When you look at a multiple, that increase that results in a significant enterprise value of that business. Now, Victory Square owns around 73-74% of it. So again, that adds to a significant chunk of our net asset value, and in a massive value that we don't think is currently seen in our existing NAV. However, even if you were to take a discount on that, so we all know that nobody knows the certainty of the market this year. The markets might continue to be volatile, multiples might continue to go down. And even if you were to take, and that multiple that's listed in there is the multiple that is current, but even if you were to take a 50% multiple on that, you're still looking at a significant gain for Hydrate as a business, but how it translates to Victory Square and the value of our shares and our ownership of Hydrate is significant. And that is what, translates to where we see growth in our NAV from this year to next year. We obviously know that, when I mentioned how our NAV is calculated, all our public holdings are basically trading at, all-time lows, in conjunction with, a 63% decline on that index as a whole. But we also believe that those companies will grow over time, but we're not even taking any sort of value when we look at our, just our NAV estimates for the next, 12 to 24 months. Only looking at our Hydrate value and at a 50% discount, we think that, again, that's what backfills into us projecting going from a NAV of, let's say 80 million where we are today to 140 million within the next 12 to 24 months, which is the growth of this company as it hits its milestones. Now, there are a couple of questions specifically that came up around Hydrate, so I think it might be a good chance to talk about them now. So why are you so bullish on Hydrate, despite the economy entering a recession? Will there still be a market for expensive treatments that some might consider frivolous? So, again, what the pandemic did is it accelerated the adoption of virtual and at-home care, and it also showcased the current stress on healthcare workers and our healthcare system. So we believe that this is something, this market and sector and space is something that's going to continue to grow, not just based on our own experience with our projects in that area, but also just within data that we've seen. Now, and again, I think with healthcare or care, it's universal. Universally, people care about feeling good, looking good. Health is, important. If you have money but you don't have health, it's almost like a priceless, item. So we believe that sector and space will continue to grow. We've seen the stress on physicians, nurses, and our healthcare system. So the virtual and at-home care spaces are one that we think there's tremendous room to grow. And this is also evidenced by transactions that Amazon has made in the sector, Microsoft's made in the sector, CVS, Walgreens, the list goes on. Now, specifically with Hydrate, services like IV drips and Botox, aesthetic and cosmetic services, we haven't seen a drop off. And, I think US and Canada specifically where we're operating, you constantly hear about mental health being a big issue, and so what we've noticed specifically around the cocktails around the IV drips is that a lot of people are taking them that are deficient in vitamin D or vitamin C. So there are certain cocktails that we're seeing that are around just again making people feel good. So now I don't know if anyone on this call has ever had an IV drip, and so it would be strange to explain it to someone that has it, but I would highly suggest and recommend trying it out to see what the impacts are to how you feel. And again, there's a lot of different types of cocktails specifically around those different types of services, but we've seen that demand for those services continue to grow, specifically at home. Now, the other thing around cosmetic services, so this is one of the things about Botox as an example, which is what are the big cosmetic services that Hydrate offers at home, is the fact that, again, I've never taken Botox, so I don't know, but from all of the work that we've done on a research perspective is that if you are taking this, you're pretty much taking this forever, because if you stop, it just regresses. And, people are always concerned about how they look and how they feel. So again, we haven't seen a decline in that sector and space. But one of the other things too about Hydrate and our other digital health initiatives is we've seen the growth of other areas from at-home care, at-home testing, specifically, other types of point of care tests, and other types of very specific services for people. So I'll get to this in actually one of the other questions as well, which again talks about some of the things that we're excited about. And when you look at some of the services that we have coming out, not just within Hydrate, but or discrete care, but within some of our other Victory Square digital health initiatives are around, very specific care around weight loss management or hormones for men, or perimenopause and menopause and other types of femtech, solutions specifically for women. So we've seen that this growth, the growth of this sector and service is significant. There was another question for Hydrate. At the last webinar, Fahid said that Hydrate was cash flow positive on an operational basis. When will it be cash flow positive, including G&A and GAAP? So we're expecting this year. It's projected this year that it'll be cash flow positive, including G&A and according to GAAP, accounting principles. Can you talk about the growth of Hydrate and when the Drip Bar business will be added to the platform? So Drip Bar is a white label app that is already released on the App Store under Drip Bar. More locations are being added to that app, but their in-store pharmacy orders have been coming in since Q4 and growing. I think in 2022 we intended for that to start a bit earlier, and there were some pauses in getting that program up and running because we wanted to make sure everything was very, very tight and smooth and steady. But I think towards the end of Q4 of last year and today, we've really seen that acceleration growing. Can you compare and contrast Hydrate to other public or private companies that have similar business models? What are these companies valued at, and how do their margins compare? So we regularly do this, but we recently ran an analysis on Hydrate comparable companies. The most similar companies, again, I was mentioning earlier that trade on the NASDAQ had market caps in the billions. So we didn't feel that these were proper, apples to apples comparisons for valuation purposes, but we did identify a couple of comparables within their vertical. So there are other digital health companies like Relic Health or Avicor or Zyban. And when we value Hydrate and these companies using an EV sales multiple based on 2023 exit revenue, the industry mean is approximately around 17 times. So, based on Hydrate's 2023 exit revenue of around 12.7, using that, 17 times EV to sales ratio, you're looking at an exit of 2023, if it hits those targets, of around 215 million. Now, again, we take a 50% discount to everything that we look at. So for our purposes, we look at that as around, 110, let's say, $1 million. So again, the digital health sector and space is one that is not going away. It's continued to grow, whether it's on the large cap or, as we've seen on some of the multiples on the micro cap space, is significant. And this is one of the reasons why we believe that this is going to be an outlier for us, because not only because of the sector, the growth, the first mover advantage, but also when we compare it to some of the comparable companies out there, we believe that our business is much more defensible, stronger. The growth is greater, but the multiple is very healthy, which again equals significant value for VST. Alex, can you jump to the next slide, please? A couple of quick catalysts again. When we look at 2023. We mentioned, a couple the spinoffs. So the spinoffs of Stardust and Draft Label. We believe that both businesses have good transactions to list. They're funded, they're growing, and we believe that with their spinoffs, it'll equal, additional significant value to Victory Square. Hydrate's growth, so kind of mentioned and talked about the growth of Hydrate and how we believe that it is an outlier within our portfolio, and it's going to contribute significantly to the growth of our value. And then NAV growth. So again, when we look at 2022, or we look at, this year and next year, we believe that our NAV is gonna appreciate, not just from a Hydrate perspective, but even if you look at the value of our public holdings are all trading at their lows. Now, obviously, not everything is going to rebound to where things were in 2020 and beginning of 2021, but we believe in our core companies. And again, we've seen markets go in cycles. So we believe that those share prices and our value, the value of our shares and holdings in that will appreciate. So really 3 major catalysts for this year. We believe that spin-offs are going to be one, the growth of Hydrate. And the third is, again, just the overall growth of our NAV. Alex, can you jump to the next slide, please? Let's get to the some of the other questions that we had. So I want to thank everyone for sending in their questions. We had a lot of questions submitted. I've kind of prioritized them in case we run out of time. But the first question that we wanted to highlight that we saw come in, which we think is important, is insider buying. So we've had a number of questions around insider buying, but there's one, I'll just read one specific question that came through. As a large shareholder, I would feel better about my holding if I saw VST insiders buying shares at these low levels. I follow a lot of microcaps and I prefer to buy companies that are doing share buybacks or management is actively buying shares when the share price is low. I know that the insiders at VST may prefer to buy into the private companies you're working with because they get more upside. But when the CEO is saying the stock is incredibly undervalued and not one single insider is buying shares, many see that as a red flag. So I agree. It's always refreshing to see management and insiders buying shares of the company. And I agree. To outside shareholders, it shows that management believes in the company. So specifically around me, anyone that's followed the Victory Square story, the business was initially founded and funded. One of the main sources of funding was a convertible note that I had set up, which the company tapped into and used that capital to make its early investments. And then what would happen is at any given time at the end of the year, I would just convert whatever I'd provided to the business into shares. I would also not get paid and just defer salary and again convert it into shares, varying based on where VST has been in trading. And this was kind of a strategy that we'd been applying from 2017 to around 2020. So I don't know the exact numbers, but I think I may have converted close to 5 million shares on multiple occasions, and probably with equaling a dollar value of around $2.4 million. At much higher levels than we were trading at today. So, and these occasions, I think, again, all of this has kind of been filed previously, but there are conversion prices from, I think, 90 cents, 91 cents to, 52 cents. I mentioned, I think I participated in converting $500,000 into the financing in 2020, I think around 52 cents. So from 17 to 20, I was participating by, within those two types of initiatives. And what was important there was, trying to preserve the company's capital. So when, the point of the convertible note was that if I was going to invest into the company or buy shares in the company, it would be by buying it directly from the company. So the company would receive dollars that the company could then use to grow, as opposed to going to the market and, let's say, buying shares off of someone else, which may benefit me or as a shareholder, but doesn't really benefit the company because the company is not necessarily receiving those dollars to kind of grow its business. And then in 2021, we decided to do the share buyback. And we've never really seen a value, whether it was me converting at higher prices or whether we did a share buyback. And maybe it's because we were a microcap stock. Maybe it was because the timing that we did it, the company was generally, share price was generally kind of in a decline during those periods. But when 2021 ended, what we'd seen was just a downward trend of not just our share price, but we start to see this overall. And so the strategy for us was just to kind of take a step back and wait. So in 2022, we just basically waited to see where the market would land. Now, for me specifically, my conversations right now, from a family perspective, are to do, and with the company, is to do one of two things: to go into the market to buy back because I do believe it's undervalued, or is it better to put a war chest aside for the company via convertible note, whereby which the company can use that capital to grow if we see distressed assets or opportunity. Again, if the market or the economy gets even more shakier, then there might be some good buying opportunities. So do I leave dry powder for the company like I had previously, and again would convert at random periodic times, which could potentially be beneficial to the company, or do I just come into the market and buy shares? So this is a conversation that is happening right now, and will be communicated to investors very, very shortly. It'll either be me announcing that I'm going to be providing that firepower for the company as a side, or two, through insider notices of buying back shares. Now, from a management and insiders perspective, the one thing about VST is we really have 4 insiders. We had 5, but it's really kind of trending around 4. There's myself, and there's 3 board members, and those board members have been the same board members that we've had since VST was started in 2017. And those board members were brought on. They're not paid, so they're not paid board members. They don't get paid. What we're brought on for the purpose of governance, audit, partnerships, and kind of analytics. Now, each of those parties. Now, I haven't tracked to see what their purchases have been in the past, but all 3 of them were not brought on to necessarily. They're brought on more from an independent perspective for the operational part of the business. And then there's myself. Vahid, who is a core insider of the business, has, as most know, has taken a huge role in the growth of Hydrate, and has really transitioned into that business. So we don't have a lot of insiders within the VST business. Now, I can tell you that people within the ecosystem, whether it be family, friends, people that work in different types of capacities that are non-insiders, have absolutely been investing into VST. When you look at the decline in the share price over the last 12 to 24 months, there are parties that are coming in. And we also know, again, that whether it be specific shareholders or people within our ecosystem have been coming in and consolidating and picking up shares. But to your point, I do believe and I agree that seeing more insider trading, or sorry, insider investments or investments by insiders is super, super important. And I think that from me specifically as the main insider, I think you will see one of those 2 things in the future. Next question here. What are other opportunities for VST you're most excited about? So we're excited about a lot of things. If you ask different people at the company, they're excited about, some are excited about Game On, having seen the company go through a very, difficult market with respect to their share price, since they've been trading. But to see that company, crawl its way to profitability and continue to, to build off of off their momentum and grow, people are excited about that. I think there's been a new management that's come into XRI, which people are very excited about, with what Shabir and Kaman are doing. And I, talked a little bit about Hydrate as well. Stardust Solar, I think given the sector and space and with the, the infrastructure bill in the US, there's excitement about that. But personally, for me, I would say that I'm personally most excited about our digital health sector. So whether it be Hydrate, what we're doing with Draft Label, or even, Victory Square Digital Health, which is, our wholly owned entity of VST. And I think it's because within different investments and businesses we go into, there's somewhere where, we almost look at it sometimes as a mercenary, where, we see a financial opportunity. And then there's some cases where we look at it more from a missionary perspective, where, again, there's a financial incentive, but we're passionate about and kind of living through what what we're working on. And in the digital health space and sector, for me, it's exciting for me because as a 45-year-old, my health has changed over the last 10 years. And I don't know if there's other, men or dads out there that kind of go through the same thing where, you don't go and see a doctor for years. You don't go, and get your physical checked. But when you get married and have kids, it starts to become more important for you. And I think for me, with the investments that we have in this sector and the key learnings that I'm seeing just that are applicable to my own health, it's resulting in some of the initiatives that we're working on specifically right now, which again, where I'm able to get someone come to the office and, because I'm always too busy to go and see a physician, to come to the office, get my blood work done, analyze my blood work, let me know, and create a personalized diet and supplement plan, for me specifically, and monitoring me, every 2 months is super important. So I think I'm most excited about what we're doing there, because when I can see the specific impact it's having on me, I can see that the growth potential is significant, but it's also something where not only do I see a financial, a potential financial win for the company, but also like it's a more of a missionary where I'm going through that process and I can really relate to how big of a value add service, that we're creating. So again, for me, that entire sector is super exciting, not just Hydrate, but also Draft Label and all the initiatives coming under Victory Square Digital Health. And I'm also excited that shareholders over the next couple of months will start to see some of those specific initiatives. And what will be exciting for you as a shareholder will be not only that you may or may not be a shareholder of VST, which is an investor or owns that initiative, but you'll also be able to potentially use the service. So that to me is exciting, because anytime you are a shareholder, but you can also use the product or service and you enjoy it or you believe in it, I think it allows for us to have a stickier shareholder and a stakeholder that's kind of more bought into what we're doing. Can you share with us the progress of bringing in new investors to VST? There are two things to this. One, there are things that we will always continue to do, push out content, attend conferences, and reach out to new and existing investors, which we are always doing. So if anyone follows the company or myself on any sort of social channel, you'll see that we're constantly trying to, to have Victory Square as presented as a thought leader in the sectors that we're in. Our portfolio companies, I've heard some comments about, something that I think I might have said 2 years ago on a Wall Street Reporter about more news than days in the week and things like that. And we do have a lot of, news, but from then to now, most of those companies have now kind of been spun off on their own and released the news independently on their own. So I think for us, consistent communicate, continue to communicate, continue to push out content, continue to attend conferences, to continue to reach out to new and existing investors. We will continue to do that. But the other point, which we've seen specifically with the microcap space, is that a lot of the movement in volume and share price for the exchanges as a whole, we need to, to see that, you need to see a momentum shift. Like the sentiment around microcaps needs to improve, and that results in momentum. So that's a variable that we can control. But what we've seen in the past is that by continuing to do these things, by continuing to reach out and talk to new and existing investors, communicate content, conferences, that when that inflection point happens, that momentum comes back, we'll be positioned well. There's another question. I see that ITG is buying VST shares more heavily over the last few weeks. Can you clue me in at all on this strategy? Are they buying a block of shares to sell to a larger investor, or are they just helping to keep the share price up until some organic buying kicks in? So ITG is our market maker. I think we pay them $5,000 a month just for basic market making services. So there's no other instructions or anything else going on. I think we have a great relationship with ITG. and specifically the market maker on our file. Their service is to market make, but I do believe that I think in certain cases where they believe in the client or they believe in the business, they may take larger positions and hold larger positions over time. So, but again, our relationship is, I think, is $5K a month, and they're just our specifically for the purpose of market making and nothing else extra to that. 2021 was a pivotal year for speaking of upswings, any news on what's got Game On going up over 90% in the past month? All I've heard was that mentioning being on track to be profitable soon. Is there anything else lighting the fire? Again, with respect to share price in markets on the microcap space, I don't know, I don't see any, any consistent momentum or patterns that have formed. I see, just the only thing that I see consistent is volatility on that. So I can't really speak to why the share price is doing what the share price is doing. But I do know that anyone tuned into Matt's webinar towards the end of Q4 or follows them, they really spent the time building out their tech in 2021, and which really paved the way for them to focus on sales in 2022, and it's allowed them to close deals, break even towards the end of the year, and even become have a profitable month in December within their sector and space is really impressive. So I think that anyone that's following their story, will see that they've done a great job of building their tech, growing sales, getting to break even in profitability, and have momentum kind of going into this year, specifically with a new initiative called Karatika, which I don't want to butcher, so I'll leave that to Matt to share. Which again, we're super excited about. Any news on Stardust Solar? So I mentioned earlier, Stardust Solar is planning on listing this year. They signed a term sheet, strong capital markets group. We don't know when this year they'll list, but we do know that the plan is to list this year. There are a couple of things specifically around it that I can probably share that are exciting. In addition to the listing process, they officially became a Tesla distribution partner. So they're authorized to sell and distribute Tesla products across Canada. They can use the Tesla brand in conjunction with all their marketing materials. And their top level staff have been training with Tesla to get their technical integration process started. So super exciting, a really big milestone for them. Couple of key additions. They brought on two really strategic people. One was a gentleman by the name of Paul Baluch. He was a successful franchise executive that worked at a company called 1-800-GOT-JUNK, and another one called Shackshine. He helped specifically with their franchise development initiatives and helped kind of scale 1-800-JUNK from, I think, 100 million to 700 million, and Shackshine from 2 million to 50 million. So he's a huge addition, for Stardust. And then there was another gentleman that they added to their board of directors, Ezra Auerbach. And so he is one of the founding members of an organization in the US called NABCEP. It's the largest renewable energy association in the US. So some big validation for them as they go into the US market. The revenues, I think in 2022, were around 2.1 million, I believe. So again, significant, and they're expecting to double that in 2023. So a lot of really exciting things about them. I think we have time. There's one more. We're out of time, but there's one more question actually I really want to get to, which I think is important, and this kind of relates to the NAV and the way that the private holdings are valued. So this next question, is it possible to get an update of the financial health of the VST portfolio companies that are not public? I understand that since they are not public companies, that do not have to divulge financial information to the public. And what type of financial information do these companies supply Victory Score Tech? So this is actually really, really important question to answer. So there are things that we cannot share with the public without permission of our private portfolio companies. So with some of the information I just gave you on Stardust is because we've been given permission to be able to do that. And when we are able to give information to shareholders, we do. But with the private companies, it's sometimes harder to do that. However, we keep a very, very close track on our large private holdings. Now, as part of our internal process of all of our investments, and then just information that's required by auditors, we're required to capture certain information from certain material information from our portfolio companies. So there's a list of documentation, and this is important. This is documentation that we keep a track of as we keep a track of our private holdings, but it's also the information that's provided to the auditors and the third-party pricing agency to properly evaluate our private holdings. So again, it's a very diligent process. So specifically, they request general updates on operations. So on an annual basis, for what's happening right now, all of our private portfolio companies are required to provide a general update on operations throughout from January to December, including any changes in their business model. They are to provide updated investor presentations, strategy documents, details of any financings, equity raises, even internal share transactions completed, or even that are in the process. And then even if there are decks that are supporting or supporting materials issued as part of those recent financings, financial statements. So they all have to provide their year-end financial statements to us, and that are shared with the third-party pricing agencies. As part of those financial statements, they include balance sheet, income statement. They're also, so today all of that information, for example, is being provided for 2022, but those companies are also supposed to provide 2023 budget and multi-year financial forecast. So again, because the auditors and third-party pricing agencies look to see if we need to impair those assets, and so they want to see that those businesses are not only active, but like what their projections are on a going basis, and a summary of their cap table. So there's lots of information that we keep a track of, and there's lots of information that's provided to the third-party pricing agency on those private holdings to be able to come up with a value. So I apologize for anyone. I ran over time there a little bit, but I hope we were able to answer the majority of questions that were there. I apologize if there were questions that were missed. Please feel free to email them to Alex or I. Again, thank you everyone for tuning in. Thank you everyone for your support. Hopefully shareholders know that I'm accessible. So anyone that's emailed us before, I'm hoping that I've provided prompt replies to everyone and made ourselves accessible by email and or call. I think Alex has gone onto the Discord channel to ask shareholders if they want one-on-one. So if anyone wants any one-on-one meetings, please feel free to reach out to him. And we're very excited about what's to come. And again, if there's anything we didn't get to, please feel free to email us. Thank you.